Good morning. Happy to be here.
I just to get your thoughts on what Esther George is saying right now. She's referencing some of the excess savings that is clearly in people's accounts. That buffer suggests the Fed may have to raise rates to a higher peak than would otherwise be the case, even though, as Steve said, she's more of a gradualist. What do you make of that?
Well, I certainly believe, and have believed for some time, that the Fed would have to raise rates faster than they expect. We're at 5.25 by March. So there's nothing. The retail sales doesn't really matter. The economy is slowing down. We're probably going into a mild recession. But this is all about inflation. They can't take their eyes off inflation. They have to talk tough. They have to be hawkish, and they got to move aggressively.
When you think about things like food and medical care and shelter, are those things that you see responding in like goods have the last 6 months?
Well, not food prices, not shelter prices, but certainly energy prices. So we've had 3 months where they've been falling, and you'll notice that the 3-month core CPI is, or headline CPI is 2%. Just so misleading, so misleading. Inflation is at a 40-year high. That's what you need to know. That's all the Fed sees.
So in light of that, Larry, I saw one analysis this week suggesting that every bad CPI report, and I realize it's not the Fed's preferred measure of inflation, but that every bad report, like the one we saw yesterday, actually delays the pause another meeting. Is that your sense as well?
Well, it's not another meeting. They're not going to pause for quite some time, but you're absolutely right. It's not their preferred measure, but it seems to come out right before FOMC meetings. And when the report is really bad, it solidifies a higher rate at that meeting. They're going 75. I know that. I never use the word no. Okay, economists and forecasters never should, but we know that. The markets have priced in a 90% probability. They got to go. They have no choice. And they want to go. They want to go 75.
So what does this mean then, I guess, as we do start to look to November? What does this mean for the Fed narrative and for Fed Chair Powell's narrative about how all of this is going to play out as we head into 2023 with inflation remaining so sticky despite what's already been such aggressive rate hikes?
Yes. He knows that. He has to speak that is consistent with that. And he shouldn't put much emphasis on anything having to do on the real side. Obviously, the labor market is still very tight. What's happening to GDP, which has weakened a lot, we're in a growth recession. We're growing slower than potential output. That means the unemployment rate is going to begin to rise. That's good. A mild recession, that's good. I always like to say recessions are a policy option for the Fed.
Employment rising to what, Larry? I mean, we've seen all kinds of estimates as to where unemployment peaks out. I think some of the highest numbers we've seen are around 5.7 out of B of A. Does that seem extreme?
No, we're at 5%, but we have to reconsider after the CPI report, the minutes, etc. So I certainly expect to go above 5%, and that's quite reasonable. A little aggressive, but quite reasonable.
Right. Certainly not a number that we're familiar with, at least lately, but we'll see how high it goes. Larry, so much we didn't even get to UK. Maybe next time. Great to have you. Thank you, Larry Meyer.
Okay, thank you so much.